Shifting focus, and this is a big news that we are seeing in what is a relief to non-banking financial companies. The Reserve Bank of India lowers the risk weights of bank loans to NBFCs to 100% from 125%. Now, this comes after the RBI in November 2023 had increased the risk weights on the exposure of banks to NBFCs by 25%. But to tell us more about these developments, we're joined by my colleague Subhana to give us a breakdown on what this means for NBFCs.
Hi, so it's a big relief for NBFCs. RBI has actually eased risk weight norms from 125% to 100%. Now they have rolled back on these tight high risk weight norms. Now it's important to understand that in November 2023, RBI had increased risk weights on bank lending to NBFCs by 25 percentage points. Now this circular will come into effect from April 1, 2025, and this will help non-deposit taking NBFCs and smaller rated NBFCs, because it will help because it will provide cheaper access to capital for them. Now in another move, what the RBI has also done is that they have partially rolled back and they have exempted microfinance institutions to bank loans to microfinance institutions to 100%. They have also said that the risk weight on MFI loans will continue to remain 100%. Now, let's roll back to November 2023 when they had come out with these norms. They had excluded housing loans, gold loan, jewelries. They had excluded these loans under consumer credit when they had increased the risk weight norms. Now, they have clarified in another circular that MFI loans by banks will continue to be 100%. Now, this is a major relief for banks and NBFCs.
Well, thanks for all those details, Subhana. In fact, we have a couple of brokerages talking about this significant development that we are seeing for NBFCs. We are joined in by Puneet to share some of what these brokerages are making out of this development.
Well, thanks for that. So brokerages have come out with what they think of this particular measure and who could be one of the biggest beneficiaries. So let's start out with Macquarie first. Macquarie mentioned that, this is one of the biggest messages in terms of, the regulatory overstate. They mentioned that a more accommodative RBI, which bodes well for all these particular players. Now, they believe that this will be good for the financial sector re-rating going forward, and it's reiterating Macquarie's bullish view on these particular stocks as well. They've also mentioned that unsecured loan growth has come down from roughly 25% to 10% in the period my colleague Subhana just mentioned. So the unsecured growth has also come down as well in this particular time weight. They believe in due course RBI is also likely to reduce the risk weight assets on these particular loans as well, and banks should see a 20 to roughly 250 basis points positive impact on the CET1 ratio as well. They see IndusInd Bank and Bandhan Bank as one of the biggest beneficiary of this particular move, so watch out for these stocks in trade today. The second brokerage is CLSA. Now, they mentioned that, after a lot of regulatory tightening over the last couple of years, this is one of the biggest positive moves for the particular sector. They see that clearly good things are happening for the banking sector in a much meaningful way, which should contribute in the numbers as well. And they estimate that Bandhan Bank will be one of the biggest beneficiaries based on, the MFI risk asset being recalibrated as well. And finally, on Morgan Stanley, on this particular topic as well, they mentioned that, they are expecting the CET ratio, which, Macquarie is also estimating by 20 to 50 basis points. For Morgan Stanley is roughly between 10 and 80 basis points, and positive impacts for banks that they cover in their coverage. And they see that the mid-sized private banks should get higher benefit of this. So overall, it's a big positive move, as my colleague Subhana also highlighted. And some of the key stocks to watch out for, of course, with the higher MFI focus, as well as NBFCs in this particular time frame as well.